In a rare move for the company, the tech giant has eliminated dozens of sales roles in an effort to streamline the way it offers its products to businesses, schools and governments.
In 2025, the second wave of technology layoffs hardened into policy rather than panic. By early November, industry trackers counted more than 112,000 technology workers cut across more than 200 firms this year. A continuation of reductions that began in late 2022 and accelerated through 2023. The names were familiar, the rationale more explicit: cost discipline, a pivot to artificial intelligence, and a preference for capital-intensive infrastructure over headcount-intensive product lines. Layoffs were not framed as temporary turbulence. They were framed as an operating model. Rewind to the first inflection. After the dot-com bust, the sector rebuilt around search, cloud computing, and mobile ecosystems, lifting demand for software roles through the 2000s and the early 2010s. The second inflection arrived with pandemic stimulus and zero-rate capital, which temporarily inflated valuations and hiring. Then came normalization, policy tightening, slower ad growth, and a recalibration of cloud expansion. The third inflection is the present one. Generative systems reached commercial readiness in late 2022. By mid-2023, boardrooms shifted from experimental pilots to enterprise rollout plans. The hiring arc mirrored this history. Headcount surged during pandemic exuberance, flattened during the rate shock, and is now being structurally reconfigured as firms substitute compute, models, and tooling for layers of white-collar labor. The demand signal embedded in hiring data confirms the reconfiguration. Lightcast and Federal Reserve researchers report that job postings requiring at least one artificial intelligence skill rose from roughly 0.5% of postings in 2010 to around 1.7% by mid-2025. Private sector barometers observed a step change. Postings listing artificial intelligence skills jumped by more than 0.7% from 2023 to 2024 and more than doubled again into 2025. Even as overall postings softened, skills rose while seats fell. The macro context tightened the vice. The United States labor force participation rate hovered a little above 62% in late summer 2025, down modestly on the year, reflecting aging demographics, caregiving exits, and cyclical softness. That backdrop matters because a softening denominator can mask sectoral churn, stable headline employment alongside rapid occupational replacement. The result is friction rather than a collapse, workers moving across functions, geographies, and credentials as firms adjust job design around machine-assisted workflows. Causality begins with firm economics. When inference costs fall, executives rebalance spending from people to platforms. The unit of output shifts from individual documents to managed workflows. The bottleneck shifts from manual throughput to data quality and model governance. Consulting notes that generative systems can lift labor productivity by a fraction of a percent to more than 0.5% annually through 2040, provided organizations reallocate time and redesign roles. That range sounds modest but compounds into large gains and, critically, rewards firms that absorb transition costs early. Boards are behaving accordingly. Fewer generalist roles, more platform engineers, data stewards, model risk professionals, and cloud cost specialists. The geography of exposure is uneven. Brookings has shown repeatedly that high-tech metropolitan areas, San Jose, Seattle, Boston, Washington, hold dense concentrations of tasks susceptible to algorithmic substitution and augmentation. The implication is not uniform job loss, but faster redesign of white-collar work in places where knowledge tasks cluster. Even within those hubs, the pattern bifurcates. A premium for workers who can orchestrate systems, and pressure on roles whose value rested on routine analysis, document preparation, or transactional coordination. Wage dynamics reflect decades of task reallocation. Research from Massachusetts Institute of Technology economists documents a long arc in which automation displaces middle-skill routine tasks, contributing to polarization. Faster growth at the top and in certain lower-wage service roles, with the middle compressing. The arrival of generative systems does not erase that history. It accelerates it in domains once thought insulated: marketing production, customer operations, junior legal drafting, and entry-level finance. The Organization for Economic Cooperation and Development warns that artificial intelligence can place downward pressure on wages, where the technology automates core tasks faster than new complements are created and scaled. Education and credentials are quietly shifting as well. The PwC Global Artificial Intelligence Jobs Barometer for the United States notes a declining employer insistence on formal degrees in postings most exposed to artificial intelligence, alongside a rising insistence on demonstrable skills. The effect is to challenge the premium of generic four-year credentials, while raising the premium of verifiable competence in data, statistics, and tooling. That trend aligns with enterprise needs. Less emphasis on pedigree, more emphasis on the capacity to design prompts, evaluate outputs, chain tools, and document controls that withstand audit. The human consequences are uneven. Senior individual contributors who can translate business objectives into machine-addressable tasks are benefiting, as are specialists in data engineering, security, and governance. Entry-level generalists face a thinner ladder. Harvard Business Review and adjacent research streams describe a paradox. Short-run productivity gains from machine assistance coincide with lower intrinsic motivation and a glut of low-quality content when safeguards are weak. Firms that remove too many apprenticeships by automating the easiest tasks discover a damaged pipeline for future experts. The organization keeps the outputs but loses the learning curve. Participation and pay are transmitting those microshocks into the broader labor market. The second wave of layoffs has been concentrated in corporate functions that scaled during the growth years: recruiting, customer success, marketing production, and layers of program management, while frontline logistics and healthcare continue to hire. The wedge widens between workers with scarce, complementary skills and workers whose activities are now easily scripted. The policy challenge is not generic reskilling but targeted, time-sensitive transitions that map displaced task bundles to adjacent roles with real demand. The numbers in postings are clear, but transitions require local execution capacity. Community colleges, apprenticeship consortia, and employer commitments to on-the-job training tied to production workloads. Corporate strategy explains the persistence of the cuts. Cloud providers, semiconductor leaders, and model developers, Amazon Web Services, Nvidia, and leading foundation model labs are expanding capital expenditure while pruning overlapping business lines. The spending is durable because workloads are durable. Once core functions run on machine-assisted platforms, reverting to manual processes is not viable. That reinforces a two-speed market inside firms: headcount constraints in non-differentiating functions, investment in roles that unlock throughput, governance, or margin expansion. Surveys from 2023 already showed that only a minority of firms had serious guardrails for generative tools. The past year has been a sprint to make those controls real, staffed, and auditable. The education market is following the demand signal. Employers are writing fewer postings that require traditional degrees for highly automated roles, and more postings that require specific model, data, or platform skills. Federal Reserve researchers quantified the shift in 2025 using national job posting data. Artificial intelligence skills are still a small share of all postings, but the growth rate is unmistakable and disproportionately high in bachelor-required roles. That combination, lower credential rigidity with higher skill specificity, encourages modular learning and makes wage outcomes more sensitive to on-the-job performance. A clear risk sits at the bottom rung. If entry-level work is automated too aggressively, professions lose the scaffolding where novices accumulate tacit knowledge. Editorial, accounting, and legal workflows illustrate the trade-off. Machine systems draft first versions with impressive speed, but quality assurance, client context, and liability live with humans. Harvard Business Review cautions that replacing the apprentice tier rather than augmenting it can weaken long-term capability, even as near-term metrics improve. The firms most likely to sustain advantage will pair machine-generated throughput with redesigned pathways for early career development. Forecasts for the next decade are measured rather than euphoric. McKinsey's productivity range suggests that artificial intelligence could add meaningful annual gains if organizations invest in role, redesign, and redeploy saved time into higher value work. Brookings expects the geography of impact to remain skewed toward large metropolitan areas with dense concentrations of susceptible tasks, which implies that regional policy needs to support smaller metros in acquiring complementary capabilities rather than competing head-to-head on raw research scale. The Organization for Economic Cooperation and Development urges safeguards around wage compression in automatable roles and points to collective bargaining and training finance as buffers. The common thread is not technology but execution. Institutions that convert exposure into complementarity will capture the upside. What changed since the first wave is not sentiment but structure. The first cuts were balance sheet repairs after an extraordinary hiring cycle. The current reductions are an operating doctrine backed by clear demand signals in postings, credible productivity estimates, and maturing governance. The work is being redesigned so that fewer people orchestrate larger systems with stricter controls. That shift advantages workers and regions that can prove complementarity at speed and disadvantages task bundles now expressible as prompts. It will reward education providers that deliver verifiable skills and penalize those selling generic credentials. It will force managers to build apprenticeships inside machine-assisted workflows rather than stripping them out to hit short-term targets. A calm outlook, therefore, rests on three practical premises supported by the data. First, task automation will continue to compress routine middle-skill roles while raising the premium on system-level problem-solving, a pattern documented over decades of research on task displacement and wage polarization. Second, employer demand for artificial intelligence skills will keep rising as a share of total postings, even if overall hiring remains flat, because firms are hardening platform choices and need talent to govern, secure, and scale them. Third, productivity gains will materialize unevenly, with leading firms and metros moving first and pulling away, unless policy, finance, and training capacity close the gap. Those premises do not predict uniform loss or uniform gain. They describe a steady sorting process in which preparedness is observable and compounding. The conclusion is not dramatic, it is procedural. The definition of work is narrowing around tasks that are complementary to machines and expanding into oversight, integration, and design. The definition of skill is shifting from possession of a credential to evidence of performance inside governed systems. The organizations that internalize these facts will keep hiring, but they will not hire the same way. The labor market that internalizes these facts will keep adapting, but it will not adapt by accident.